So here we go. We're here today to talk about how to finance investment property with commercial loans. And there's a lot to learn here, folks. So I just want to welcome you to Leanne Riley's Real Estate Investing Made Simple Club. And we do live interviews with experts and leaders in the real estate investing world. And I'm Leanne Riley, broker and real estate coach, and I lead the Encore investment team of realtors in the Twin Cities, Minnesota. And I built a multi-million-dollar portfolio in residential, multifamily, condo development, commercial, and vacation properties. There's a lot of ways to make money in real estate, isn't there, Brandon?
Oh yeah, there's a ton.
There's a ton. And as a national coach, I actually help people get started or how to scale a portfolio without confusion or fear with my proven profit formula coaching program. And it includes group coaching. And I just love meeting with my group and watching how fast they can grow portfolios when you have guidance. One more thing. Check out my YouTube channel and you'll actually find these interviews on there, and it's called Leanne Riley Real Estate. And then when you're there, be sure and subscribe. So there's one more thing about today's meeting. We're going to start something, this pre-COVID, I already was doing them virtual before, because you know why? I'd have it at a hotel, and then if it rained, nobody would show up. Right? It's snowing today. I don't want to go anywhere. So virtual is so much better, and it's recorded and you don't have to worry about the lights. So I love this because we can listen at a time that works for us. But today, at the end of this meeting, feel free to stay on, and we're going to do some networking so you can meet the other people here, because that's how deals get done too. It's the people you meet. So we're going to stay on and do that today. Okay. So don't forget. So today, commercial lending, and my question is, how does it work? And that's what Brendan is going to go over. So I want to introduce my guest today, Brandon Plombon. He's the Assistant Vice President and Business Banker at Pioneer Bank, and that would be the Mankato branch. He has a unique background in managing insurance risks and financial risks. And that's unique to have that together. In addition to his years in finance, he holds his life and health insurance license as well as his property and casualty license in the state of Minnesota. And he has also owned his business and insurance brokerage. That gives him firsthand insight into the challenges and rewards experienced by fellow entrepreneurs. And that's us, the real estate investors. And, wouldn't it be fun to be able to ask your banker about insurance also? So that's the bonus. So hello, Brandon, and so glad you can join us today.
Thanks, Leanne. I appreciate the kind words, and I'm so glad to be here. I've been looking forward to this meeting for quite some time.
Cool. And I always tell people in here, how did I meet our speaker? And I want to give a shout out, I guess, to Bigger Pockets, because Brandon reached out to me from Bigger Pockets. And as you guys all know, that's the fish pond for real estate investors is what I call it. And I like to hang out over there. So he reached out and we connected. It turns out we actually live nearby each other. So we met up. And so I want to start with a question for you. I found on the bank website under your bio, you had a quote, and it said, "Life doesn't require that we be the best, only that we try our best." So why did you select that one, or is there a story behind it?
Sure. Yeah. So that's a quote that, not that exact quote, but very similar, as my dad would always tell me, hey, there's always going to be someone better than you, but as long as you always try your best and give your best effort, you'll always, get ahead in life. So that was kind of why. And it just, I found that quote and it just kind of stuck with me. And it was interesting and relatable to me because, we're not always the best at everything. I'm definitely not the best at everything, but, I try to stick to what I'm good at. And then, as long as I try and put in the effort, things will happen, and we'll make things happen by trying. Showing
cool.
up's half the battle.
And, you have a couple young boys, I bet you tell them the same thing, right?
Yeah. I've got an 8-year-old and a 3-year-old, and the 8-year-old, he's in 3rd grade right now. So really just telling him, hey, it's okay not to understand, your homework, but I want you to try your best. And, as long as you try your best and do your hardest work, that's all you can do. Right. So
all you
I
can
won't ever get mad at you if you try your hardest.
What a great thing your dad taught you. So, okay, now one more logistic before we get started. And this helps Brandon and I see who's on here with us so we can speak directly to you guys. And I have a little poll here I'm going to run. And it just tells us who you are and where you are in your real estate investing. And it just takes a second here. So all you do is pick the one that you are. And we want to see who we're talking to. And I'll leave this up for about just 10 more seconds. We got some buy and holders and some getting started people. Oh, it's moving around, isn't it? All right, finish up your vote. Oh, they're still on it. Okay, and then I'm going to end the poll. And this really helps us. I'm thinking it'll tell us who won here. Yep, here's what we got for the results. We've got buy and hold people here is the biggest category, but we have a little bit of a mix here of some people getting started, fix and flippers, some short-term rental people, and scaling is another pretty high one because that's where you really need a good relationship with the bank. So that's great. Now we know who's on here. And I just want to tell you, you can use the chat box or the Q&A box, either or, to put a question as we go along. But what we're going to move to next, and this will really help things, is Brandon has a presentation. Banks, they got regulations, right? That's what I thought. But you know what? I'm glad he has a presentation. So we're going to learn some things to answer the questions that I put out there, like, how do you work with a commercial lender and what is their underwriting criteria? And what do we need to do to be favorable to them, right? And how do we accelerate? He has some formula here. So let's go ahead and let him show us and teach us a few things. And then we're going to hit him up with all our questions, okay?
Perfect. All right. Thanks, Leanne. Let's see. Is that working? Can everyone see my screen?
Yep, if you do the slideshow part now.
All right, perfect. All right, perfect. Here we go. All right, so again, my name is Brandon Plombon, and today we're going to talk about financing investment properties with commercial loans. So here's kind of an outline of what we're going to cover today. Again, it follows Leanne's posts that she's posted out there with her marketing. So we're going to have an introduction quick on commercial loans. We're going to talk about the structure of commercial loans, a few of the differences between commercial and residential loans, as well as we'll talk about some of the common fees that you'll see on commercial loans, as well as kind of the underwriting criteria of what I personally and other bankers and financial institutions will look at when we're underwriting an individual property or borrowers. And then we'll do an example of a Schedule E and a DSCR example and just kind of go straight into that. And that's where probably the meat and the potatoes of the whole presentation would be, running the Schedule E calculation and just giving you guys an insights to what the bank is really looking at when we're calculating our numbers for investment properties. And then the last thing we're going to talk about is accelerated access to capital. How can you get faster access to capital? So
I'm looking at the first slide still, just so you know, not the.
Are you?
Yeah.
Let's see.
No, I'm not sure why.
Okay.
This will be, I'm still seeing the first slide. Eric, somebody in the chat box, are you seeing just the first slide or did you see the presentation outline? Help us out.
New share.
Just the first slide. So, okay.
First slide. All right.
You got to put it on hit the slideshow button.
How about that? Is that better?
There we go. Yeah.
Okay, perfect. All right,
Otherwise,
sorry about that.
You know what? To tell you the truth, we're talking numbers. I was never going to be able to catch up if you didn't show us the right slide. Okay.
Perfect. Yeah, no worries. So this here's an outline again of what I just said for what we're going to do for today's presentation. So introduction to commercial loans. A commercial loan is debt-based funding arrangement between a business and a financial institution, such as a bank or a credit union. And it's typically used to fund major capital purchases such as real estate, business equipment that the business may not be able to afford with their cash. Leanne talked about earlier, using other people's money, and what better way than to use the bank's money to really use a 5 times multiple on your cash. So by using leverage and borrowing money, you can buy stuff up to 5 times more expensive, and you get 5 times more purchasing power by using the bank's money instead of your own. I
got a cute little story here, and this will age me, you guys, but in the dinosaur days of computers, I owned a publishing company and we couldn't afford our first computer. So we had to go to the bank. And I remember the first computer was $12,500, you guys. Just a FYI.
That's amazing how far technology has changed and come.
But thank goodness the bank was there, because we couldn't fund it.
Right. So so there's a lot of great examples. And then with real estate, we can really, leverage up to 5 times. So we can go up to, and we'll get there, but 80% loan to value on commercial properties. So let's see. Next slide. All right, you guys still see my slides?
Yep, I see the structure one.
All right, perfect. Yep. So quick structure of commercial loans. The rate, there's always different options. We can either do a fixed rate where the rate stays constant throughout the entire duration of the loan, or they could be a variable rate. And oftentimes you'll see more variable rates on the commercial side of the bank as opposed to the residential side. So some of the common indexes is how you'll see your rates tied to. So they'll be tied to Wall Street Journal Prime or Federal Home Loan Bank or LIBOR or other bank indexes. And essentially, it's just another entity that tracks interest rates, and your interest rate would be tied to a index fund. So, there's been a lot of talks lately of Federal Reserve raising interest rates. What is that going to do? So if the Federal Reserve raise their interest rates, more than likely the indexes will also raise their rate. So if the Federal Reserve meets here coming up again in March, and if they raise the rates, quarter point, Wall Street Journal would go up a quarter point. So that's that's the first thing to look at, which is probably the most common, would be the interest rate. Everyone knows, and that's the most common question I get. What's your rate? Well, what kind of loan are we looking at? Are we looking at a fixed rate? Are we looking at variable? How long is the loan? And that gets us to the next question, which would be the term. So typically the most common are 5-year terms, and the most common would be a 5-year balloon, which is going to be slightly different than if you're used to a traditional 30-year fixed mortgage. A balloon is the rate's fixed for a total of 5 years, and then after 5 years you have to renew the note. So it's fixed for 5, and then after 5 years you're going to have to renew it again, and then in 5 years you're going to have the same fees. You're going to have your appraisals, your closing costs every 5 years. This way, because there's more risk on the business side, with we got to keep track of how well the business is performing. Are you performing well, or there's less risk than people's primary homes, where everyone wants to make their house payments so they have a place to live. Oftentimes the house payments are going to be the first things that they have to do, and then the rental properties are the payments that will get missed or get cut because it's not as important as their primary residence. So you'll see terms as short as 3, 5, 7, 10-year balloons are probably the most common, but 5 years are pretty standard in the commercial world. The next thing is the amortization.
Wait a second, I can hear your microphone crackling or something. Okay. So
perfect.
The 3, you say 10-year balloons are the most popular?
5-year balloons.
Oh, 5. That's what I thought.
Correct.
Okay.
Sorry. Yeah.
5 are the most, yeah. And so do you get a better rate if it's a 3-year balloon?
Potentially, yeah. You potentially could. So you could get a better rate on a 3-year balloon because we're tying up the funds for less time, right?
Okay.
Where if you look at a 7 and 10-year balloon, the rates are going to be higher rates because we're fixing the rate and fixing it for a longer period of time.
So basically, the higher the term, the higher the rate.
Generally speaking, yes.
Okay.
So, yep. And then the next one is the amortization. Typically, you'll see banks go out to 20 years or 25 years. Really depends on the bank and the financial institution. But generally speaking, 20 and 25 is fairly common. And that's really, if you take 5-year term and divide that by 20, you're going to have to renew that note for that property a total of 4 times over the life of the loan. If you're on a 25-year amortization, you'll renew it 5 times.
And
the last thing,
you said we have to pay the appraisal and some fees every time.
Correct. Okay. Yeah. So every 5 years, you're going to be paying your loan fees. You'll be paying your appraisals. You'll be paying title work. If there's new money added, if you're taking out some money, cash out, there may be additional mortgage tax. There might be additional fees. But generally speaking, yes, every 5 years on a balloon, you're going to be repaying title work, appraisal, and loan fees every 5 years. There are some ways that we can avoid that. I won't get in that today, but there are ways that we can set it up where it just automatically renews and saves the borrower a lot of fees. So, I mean, if you're talking $5,000 at renewal fees, every 5 years you're paying them, that's $25,000 over the life of the loan. So there are ways that we can cut those costs down to help the borrower. And essentially what that would do is guarantee renewability. So after every 5 years, when your payment would balloon, we can either call your note, the bank, and say, hey, sorry, things aren't working out with you as a borrower. I want you to pay us off. And then that's where a lump sum would be paid off. And then you'd have to either pay us off, find financing elsewhere. So that's one of the nice things is we could look at a potential option of doing that. So there's ways around that where essentially the bank can't call your note and ensures that you have guaranteed renewability. So there are ways to do that. And again, I can't promise you what the rate will be, but hey, at least you're guaranteed renewability. And as long as you're paying your loan payments, don't really care a whole lot as your bank, right?
Okay.
And then the last thing that we would look at is our loan to value, or LTV. And that just means that based on the appraisal that we get ordered, we can go up to 80% loan to value on 1 to 4 family houses. So that'd be your single family rentals, your duplex, triplex, and your fourplex. On commercial properties, once we get closer to the 5+ units, generally speaking, it's going to be at 75% loan to value.
All right.
Right.
I noticed amortization is 20 to 25 years. I always thought it was kind of stuck at 20.
Yeah, so it really depends on the financial institution. It used to, a lot of people used to have it at 20, but some banks have gone, like Pioneer, for example, will go out to 25 years. And, we'll stretch out the amortization slightly longer. So it'll help your cash flow and lower your payment. So it'll help that. And the thought process is, hey, if a building, if you're buying a building today and you put 20 years on it and it was built in 1980, it's already, 40 years old on the building. And, if you're putting a 20-year amortization, it'll be 60 by the time your note's paid off. So, I've seen even in rare cases 30-year on commercial real estate, but those are for the more $5, $10, $15 million projects.
Yeah.
So, but generally speaking, 20-year amortization is standard. And again, we'll go up to 25. Some other banks will also go up to 25. We're not the only one. So quick breakdown here of just kind of comparing commercial real estate. versus residential real estate, the interest rate on the commercial side is generally higher. So it's generally going to be slightly higher than if you got a fixed 30-year mortgage. The residential side is going to be lower. The down payment required on the commercial side, again, it's going to be the inverse of that loan to value. So it'll be at that 20 and 25% required down payment on commercial properties, as well as on the residential side, you can get as low as 3.5% with FHA. Really, you could get down to 0% with a rural USDA loan. But generally speaking, most people will go with FHA at 3.5%, or they'll do a conventional at 5, 10, 20% down. Maximum loan to value, I kind of already talked about. On the commercial side, we'll go up to 80% loan to value. And then the residential side, the bank could go up to 96.5% if it's 3.5% down. So again, just inverse relationship there.
I have a question right there, because what I noticed, we're in COVID times and all that. It seems like with clients I've written deals for, that the bank is a little less likely to go 20% down, and they're leaning more toward 25.
For a while there, I would agree with that. I think right during the heart of COVID, when things got really tight, I think generally speaking that would be. But now things, I feel like, have loosened up slightly, where it's going to depend on your financial institution and your personal financials. But I know lately I have been seeing and requiring 20% on some borrowers. So some of them, if they're a little more risk to the bank, we might require the 25.
And it makes a big difference sometimes for the investor.
Well, because that's
cash flow now instead, have to put that down in, Yeah,
I mean, exactly. Even on, $100,000 property, that's an extra $5,000 that you'd have to come up with just to buy that. And there not a whole lot of $100,000 properties around. So, times that by 2 or 3, and you're talking 10, 15,000 in additional money.
Yep.
So then the term I already talked about is a 5-year is fairly common on the commercial side. On the residential side, you'll see it's fixed, your fixed rate for 15 or fixed for 30. And then again, the amortization is going to be 20 or 25 years on the commercial side, whereas the residential side is going to be amortized over a full 30 years because it's a fully fixed rate. So really the question is, why would anyone want a commercial loan? Looking at this, all the terms generally that you see on the screen are worse than the residential side, right? There's a couple reasons. One is once you hit your FHA requirement and it used to be 10 properties, then they'd require you to go in-house on the commercial side, because once you hit your property limit, or because you want to add it into an LLC or an entity. And that's where the residential side, we're not able to put a property into an LLC. There's ways around it where you could technically quit claim deed the property over to the LLC after, but then that, opens the door for a bank could potentially call your note because you transferred title. So the commercial side there's a lot less red tape, I would say, as far as consumer protections. So there's not as many consumer protections on the commercial side, which allows us to move a whole lot faster sometimes. So we have flexibility. Once you have a good banker, you can ask for stuff and they can generally move fairly quick, without having a lot of the red tape, assuming it still meets all the regulations. And I say less red tape, but there's still going to be a ton of red tape because it's a bank. So, and then the next two would be, you can have it in your personal name on either the residential side or the commercial side. You can get a commercial loan in your personal name. You don't have to have an LLC to do a commercial loan, but it's just a benefit of doing a commercial loan is you could have the new LLC be the borrower, and then you as an individual could personally guarantee that debt. And then
I got a couple questions, so I'm going to read them to you.
Sure.
Are there any interest-only options in commercial loans if the loan to value is 65%?
Yeah, so there are some ways that we could do interest-only loans. Generally speaking, construction loans is probably the most common where you'd see interest only. And again, I don't know if the 65% loan to value would be for lots that you're planning on building on, because there are ways too, if you're buying vacant lots and you're going to build on them, there are ways we could do interest only on those lots with a plan for you to build a house or build an investment property on there. So there are interest only loans, and it really depends on what kind of project is going to be completed. If it's a full gut job, it could be interest only for 6 to, up to a year. If it's just, quick remodel of the kitchen, we could give you, maybe a month or two, maybe 3 months of interest only. So it really depends on the project. But yes, interest only is much more common, as opposed to the residential side where it's really not an option.
Now I have an audio. We got an audio. I say something, Brandon.
Yeah, can you hear me?
Oh yeah, I can, but looks like your phone maybe, or another connection, not quite sure. Check your phone.
Okay. I'm not sure what that is.
A third person, you showed up, but I'm not sure.
Yeah, I see that. I don't know.
Maybe I can kick them out. But I don't want to kick you out. So it's okay. There's nobody.
Okay. Okay. As long as you can still hear me, then we are good.
Keep going.
1 second. Let me go back. There. Okay. And were there more questions there, Leanne?
There is a couple more, so let's hit them. Is it common to use a commercial loan to get into a property and then refi to a residential loan once you can get the income on your taxes?
Yeah, I think that is a very common strategy that I see a lot of times. Oftentimes that strategy will be used more when there's going to be like a flip or a fixer-upper type property where, hey, I need to do this, I need to remodel the kitchen, I need to do the bathroom, I need to improve the property somehow. And then once they have proof of income on their taxes, then they, will refi it out on the residential side to get the better term. So they'll pay the higher interest rate, short term, and then they will refi it out once it makes more sense for them.
In that commercial loan, can you wrap in, say the construction is going to cost you 30 grand? You can wrap that in it?
Yeah. So, yep. So we can also finance the construction costs. In this presentation, I really didn't talk about anything about construction costs and construction, but yeah, we could finance the construction costs. The most common way would be on the appraisal. Let's say, you buy a property for 100,000. Right. And then we'll order an appraisal. It verifies the value at 100,000. And let's say you put in 50,000 into it. We can finance that cost. Again, we're not going to go over that 80% loan to value there. And then we would have a title company do the construction draws. And then let's say now that the property is all fixed up, we get what would be called an as proposed appraisal.
Yep.
So, hey, if you make all these changes, you do the bathroom, the kitchen, and make a few other changes. Now it's going to be worth 200. We'll have an inspector or an appraiser go back out there, verify, yep, the work that you said was going to be done is done. And now, boom, just like that, you made an extra 50,000 in equity by doing all the work. So, yes.
Okay, there's another question. Alex has FHA property limit for your name or for the LLC?
And again, I don't know the exact FHA limit. I know there are rules on that. It used to be 10. But it used to be in your individual name, I believe, because they wouldn't be able to put a FHA property into an LLC. But again, I'm not a residential mortgage banker, but that's from my memory.
Okay. Somebody wants a recommendation, but I'm going to leave that one till later. So if I title each property to an LLC, does this still count? I'm not quite sure what the question is, because the bank is lending generally to an LLC, right?
Right. Yeah. So they would be lending to the LLC. And I'm not sure if that would be the comment I made where you could quit claim deed it over on the residential side over to the commercial side. I'm not exactly sure what the question
Yeah.
is, I guess.
Not sure. Okay, so then somebody says commercial interest only is not an option.
That is not true. I did one just recently, actually in Minneapolis, North Minneapolis, in the North Loop there. And we did 3 months interest only for a what would be a flip property, fix and flip. So 3 months interest only. And after that, it just goes to regular P&I payments. So principal and interest payments.
I really like that because I think that's one of the things I really wanted you to talk about, is because there's a lot of fix and flippers who you really have to get creative with your financing. And, you know, hard money is one way, but banks are another way.
Right. Yeah. And the nice thing with banks, yeah, there's more restrictions, and we can't move as fast because we need appraisals and title work and all that kind of stuff. But, you know, our rates are cheaper. You know, you're not going to be paying 7, 8, 9, 10% for hard money.
12, 14%. Yeah.
Yeah. Whatever you can get for hard money, right?
It's fast. That's what it is.
Right.
Okay, Ravi wants to know, larger apartment buildings have low cap rates to make the monthly, quarterly distributions to investors. It makes sense to have interest-only debt in the 65 to 75% loan to value. Is that possible?
Yeah, so that would be more of the larger projects where you have outside investors, where you have the word's escaping me, but where you have a group of outside investors come in.
Syndication.
Syndicate. Thank you, Leanne. Thank you. So yeah, a syndication, that's where that would be most common on interest only deals. But for the average, you know, commercial real estate investor or real estate investor, that wouldn't really apply. But I would agree for larger apartment buildings, that is correct.
Okay, and then one last one, I'm going to let you go on, and
Perfect.
that's, is it a separate construction loan if you did it that way, or is it all included together? You know, because once you get the construction done, is it all together or it's separate?
Yeah, so 2 different options. We can do it either way, is the short answer. But most common is do it all in one. So we'd have a construction cost, and then once the construction is done, we'd just switch it to P&I payments. So interest only during the construction period. Once the construction is done, switch it over to P&I. Yeah.
Okay, I'm going to let you keep going so we get to the end of your presentation, because we have a ton of questions.
Perfect. Sounds good. They're good questions, though. So I'll go through this slide pretty fast because it's really not that important. But as far as the bank fees, these are typically what you would see. Most common is a 1% origination fee, which is 1% of your loan amount. So if you are buying a $1 million property, that's a $10,000 origination fee to originate the loan. The next one would be some kind of document loan fee, underwriting fee. You might see it as different names, but ultimately it's going to be the same type of fee. You know, they range from anywhere from like $200 to $500, generally speaking. So we have costs at the bank where every time we print loan documents, we pay a third party that spits out the loan documents for us. So that's really what that is. You know, we get billed, so we just pass the fee along to the borrower. Internal evaluation fee. This is essentially just an in-house eval or an in-house appraisal. And what that is sometimes we can turn around appraisals much quicker, because right now appraisals where I'm at, they're about 4 weeks out to get an appraisal, where I could have one of my credit analysts do an internal eval probably this week yet and turn it around. So it can move faster. The downside to doing an eval is that they just won't get the same value. They aren't licensed, so they can't make adjustments to properties for granite countertops, swimming pools, all the fancy stuff. Really all they're left is price per square foot and price to tax assessed value. So if you need something done quick and you're not looking to do a cash out, potentially could be a good fit. Otherwise, more often than not, I recommend appraisals because you'll get a better value you get more bang for your buck. But if timing's of issue, we could use a eval. Credit reports, the next one, sometimes you'll see them. We don't charge for credit reports here at Pioneer Bank, but other places you might see it. And then a flood search. If a property is next to a lake or a river, it might be in a flood zone. And then in that case, the bank would be required to have flood insurance. Let's see. All right. And then third-party fees, I kind of already mentioned, but title work, title insurance, title opinion, or O&E. Sometimes it'll be an attorney opinion, but essentially just stating that the property is free and clear and marketable. Make sure that you own the property. There are no other, liens on the property. So if you're looking to get a loan, the banks are going to want to know who else has a lien on the property, right? And then appraisals to see what the property is worth. Recording fees would be your recording fees to the county to record the mortgage and other filing fees. And then the last one would be mortgage registry tax, or MRT. And that's just to record the mortgage, and it's just a tax. So those are probably the most common fees.
Is there, if I took that into consideration, is it roughly 2.5% of the loan value? What's our?
Yep. Yeah, so it's actually 0.0023. So if you take whatever your loan amount is times 0.0023, at least in Minnesota. It could be different for other states.
That's good to know, because it's nice to have that number.
Yep. And it's helpful to, as real estate investors, calculate what your out-of-pocket costs are going to be at closing. So.
Okay.
The next one is really commercial underwriting criteria, is what the bank is really looking at when we're looking at your financials. So the first one is Ebitda, which is your earnings before interest, taxes, and depreciation and amortization. So essentially, it's a mouthful, but essentially what it's stating is, are you making money, right? Is what we're looking at. Are you making money? Is it positive? Yes, you're making money. If it's negative, you're not making money. The next one would be the trend of the Ebitda, is if it's going over the past 3 years, is it up and continue to go up? That's good. If it's kind of wobbly, what happened? Was COVID a down year? Did that affect your business? So there are some things where, hey, I understand COVID happened. I think a lot of people understand COVID happened. It hurt a lot of businesses, but looking at that trend to see what's the general trend of the business, or if it's on a decline, why? What's happening? The next one would be working capital, which is really just a calculation of your current assets on your balance sheet minus your current liabilities to calculate your working capital. And really, we just want to see what kind of liquid assets do you have. That would be your current assets would be cash, easily liquidated investments, accounts receivable, stuff that you can easily turn into cash within the next 12 months. The next one would be, there's a bunch of different financial ratios that could be used, but one that we use is equity to assets. Just seeing, do you have equity in your assets? So do you have equity in your rental properties, or are they all levered up to the max at 80% loan to value? It's very common for real estate people to be levered up to the max. And if that's the case, sometimes, me at the bank, I'll have to be like, hey, John, you got to slow down. You need to sell a property, or I can't give you any more money until you pay them down. So otherwise, if you have a free and clear property, you have no liens against it, that's would help, because you'd have 100% equity in that asset. Next one would be discounted loan to value. So we take the value of the property based on the appraisal or internal evaluation and divide it by your loan amount to see what kind of risk is there to the bank. Is the property, typically on this one are 80% loan to value, but we'll discount it based on the loan amount and the property value. And then the last one is probably the most important one out of all of them. If I had to pick one, that's probably the most important one. And oftentimes on bigger pockets, you'll look for, or you'll see it as DSCR lenders or DSCR loan, but it stands for debt service coverage ratio. And it takes your Ebitda and divides that by your debt service on each property. So your debt service would be your 12 months of debt payments. And the next slide will be an example of how to calculate that, and it'll basically run you straight through that. So
I was going to ask you a question about that, but I bet you're covering it. So
sure.
Let's see.
You want me to stop asking questions?
No, I want to see we had 2 questions here. Let me catch us up on that. You were talking about that internal evaluation. Is that normally done for properties when they come off the loan term, the 5 years is up? Do you don't, or do we
Yeah,
do a
so
real appraisal?
Yeah, so we could do it then, assess, especially if there's no new money, and you've made your payments over the last 5 years. More often than not, hopefully the real estate market hasn't crashed or tanked. And if that's the case, yeah, we could look at doing it. It's going to be slightly cheaper. I think our internal evals are about $150, $250 versus an appraisal could be upwards of $500 to, if it's a large, apartment complex, it could be a couple $1,000. So there are cost savings using that as opposed to an appraisal.
Okay, I'm going to let you teach us about debt service cover.
Perfect. All right, so this here is a picture of a Schedule E, and it's from your tax return. So if you had any properties that you owned really any year at the end of year end, this example is for 2020 right here. And then you'll see right here, it says fair rental days at 365 days. So that means this property was rented out for the entire year in 2020. And then if you look right below that, and I know these are hard to see on this slide, so the next one I do have it in an Excel sheet, but I just wanted to kind of show you what you would look for. So really, if you had any rental properties on any tax return, you can calculate your own debt service coverage ratio with a spreadsheet, and I can send that to Leanne, and we can send that out to all the members here today and everyone else, so they can kind of calculate their own debt service coverage ratio to see how well are they performing. And that's one cool thing, is you can do that for each individual property. You can do it as a portfolio. You can kind of do it however you want. But we at Pioneer Bank, we do each individual property, and we'll also do a global. So you'll see on this property, it had $29,000 in income here. And then you'll see all the different fees there's an auto fee, there's an insurance fee. And these are what they report on their tax return. So these are actual expenses that they told to the IRS what the expenses were. You'll see the mortgage interest, repairs, supplies, taxes, utilities, and you'll see the number right here, the 8612, and that would be on the next slide. Let's see, that would be their net income right here. So again, I just took all the properties here, or all the information on this property. So again, you'll see 29,000 in revenue, put all their expenses here to get a net income of $8,612 for the net income. And then if you'll remember to 2 slides back, we don't look at net income, we look at Ebitda. And Ebitda would be adding back in your interest payments, because interest payments are payments that you made to the bank. So we add that in so you show it as an expense on your Schedule E, but we'll add it back in as cash, because that's how we would get paid, because we get paid the interest, as well as we add back in depreciation, which is right here, $5,600 on this property, because depreciation, it's a non-cash item. It's a phantom expense, if you will. It doesn't actually, you're not paying out of pocket, as well as we would add back in amortization and other interest. In this case, there's no other interest. So that gets us to an Ebitda right here. And again, I can send out the Excel sheet so you guys can play with it, plug your own numbers in. And then the next one would be the debt payment. And on this property, I believe the properties were $895 and some odd cents. And then you take that times 12 for your debt payments, and that gets you to a DSCR of 1.56 in this example. So,
okay. And I know banks, like they like 1.25 or better, right?
Yeah, so it depends on the bank. Every bank's going to be slightly different based on their loan policy. Banks, our bank, Pioneer Bank is the bank that I can speak to. Ours recommendation is 1.2 per policy. So we like to see 1.2. And if you see it at 1.00 or a 1-to-1, that means every dollar that you intake goes out to expenses, and you break even at a 1-to-1, right? So if it's a 1.2, that means there's a 20% cushion or a 20% margin that we have at the bank for a safety net. Warren Buffett always talks about, having a margin of safety. That's the bank's margin of safety right there, is that 20%. Some more conservative banks, they will go to 1.25. Other non-conservative banks could be as low as 1.1 or 1.15 even, I've seen them. So it really depends on your financial institution and the bank. But, and for example, let's say, you buy a property and right now it doesn't cash flow, you're losing money and, your Ebitda is a negative number. How does the bank look at that? If you're if you're more of an appreciation investor where you're buying properties in hot markets that are appreciating very quickly, you're probably never going to, in the next 5-10 years, make cash flow on that property. You're not going to make any money unless you sell it. So in that case, a property may be negative, but as long as you have other income or other assets to sustain the loss, we'll look at right here, we'll look at your global. So if one property is down, and let's say, you had a bad tenant in there due to COVID, they had a moratorium where they didn't have to pay rent. So that's why the property looks bad on paper. As long as you can explain that and tell your banker, hey, so-and-so hasn't paid rent for the last 9 months. I can't evict them. I can't do anything. I'm stuck. So as long as you can explain to your banker and you can keep making your payments globally, let's say you're a real estate investor on the side and you have a full-time W-2 job that you can kind of subsidize the rental property, we'll look at that as well.
That's important when you're scaling a portfolio, because as I built one, that was critical, because some of them you just bought, you're still fixing or whatever is going on, and they all don't look pretty at the end of the year, but by the next year they'll be done and tenanted or whatever. I bought condemned buildings in the inner city and they took a long time to fix up a fourplex. Too long, yeah. But they took a long time.
Right. And I have one borrower in particular, every other year, he's kind of up and down. So one year he'll look amazing. The next year he'll look bad. And the reason is because in the bad years, he's buying properties and fixing them up. And in the good years are when they're all fixed up. So really there's some cyclicality there, and really just building that relationship with your banker and making sure they know how your bank operates and what your business is. Make sure they understand your business and say, hey, I know it's going to look bad on paper. And now that you have, once I send this out to everyone, you'll have it. You can calculate your own DSCR. Say, hey, I know my DSCR looks bad. I'm short, X dollars, but this is what happened. And this is where my projections are. So you can also do a projection in the sheet where you can basically just change your rent and say, hey, let's say I buy this property as it sits, it's at, 0.87. But if we raise rents $200 a month, now we're at a 1.3 or whatever the example is. But there are ways where you can show projections, and if you can talk to your banker intelligently and say, hey, this is my projection for my DSCR, then more often than not we'll look into that and consider it.
Good to know the formulas.
Yep. Perfect. Do we have any more questions, Leanne?
I do. I have how large of a loan amount can your bank finance?
Sure. So each bank is going to have their internal lending limit. So it's going to depend on each individual bank. So obviously your big national banks are going to have much larger, essentially unlimited, with, JP Morgan, Chase, Wells Fargo. But at my bank in particular, Pioneer Bank, it depends. We can go up to, without getting creative, our board will approve anything over 5 million, but we can go up to, we just did a brewery for 16 million. So, and oftentimes once you hit your bank's internal lending limit, they'll on the back end, you won't see it ever, but on the back end, they'll participate it out to other banks, and they'll ask other banks to take part in the deal once you get to a certain dollar amount. But generally speaking, our bank will do anything really up to 10 million or so.
That's exactly, as I built the portfolio, that's what happened. And, I would have never known, except for I actually was working with the bank president on something else. And that's when I learned, you banks partner, you small banks particularly, and together, then they can do those higher limits.
Correct. Yeah. So yeah, it's on the front end as a consumer or a business. You won't see anything. Your bank that you originated at, they'll service it. They'll charge the other bank a servicing fee, and yeah, you won't see anything on the front end, but on the back end, that's how it works behind the scenes.
Jeffrey's asking, that DSCR ratio, the bigger banks are probably more conservative, or 1.25, and you said you even did 1.2, because I had a guy who they stopped him at 1.2. Okay, you didn't make that. No.
Yeah, and oftentimes with the bigger banks and even some of the more regional banks, I won't throw out names, but it's very cookie cutter. Either you fit in their box or you don't.
Absolutely.
With community banks, which what we are at Pioneer Bank, or credit unions, oftentimes there's much more flexibility where, even if it's a 0.19, I can go to bat for my customer. I can say, hey, I know it's technically a policy exception. We'll cite it. But as long as everything else looks good, there shouldn't be a reason not to, just because it's slightly short. So
if everything else is in line.
Right.
Okay, somebody else wants to know, do you finance properties only in Minnesota, or you're in, I know you have a Mankato and other branches, right?
Correct. Yeah. So generally speaking, Minnesota and the surrounding states would be kind of my playground. So anywhere in Minnesota would be ideal. Obviously, Mankato would be ideal, but again, I understand, the bank understands. I think any kind of real estate stuff, it would have to be North Dakota, South Dakota, Minnesota, Iowa, or Wisconsin.
Okay.
Midwest.
You're Midwest.
Midwest, correct. Yeah. I mean, there are some exceptions. I did one recently. I did a $4 million jet loan for a borrower that was out of state, but because it's a jet, it's FAA tracked and other stuff, but it depends really. So as far as properties go, I don't want to be financing properties in New York or California. Really, there has to be some kind of ties to Minnesota or, Sioux Falls or somewhere in the Midwest, right?
Yep. Okay. Do you have more?
Do you have more? Yeah. So, and then I have 2 more slides. So
good.
Yep. So the next one is just, what do you need to do to get accelerated access to capital? So typically we'll need 3 years of business tax returns if they are available. If it's a brand new entity, I understand you're not going to have 3 years. So whatever is available. So if you only have 1 year, 1 year will suffice. And then, because that's all there is, we'll need year-to-date profit and loss statements for the business. So if you just started the business at the beginning of this year, we'll need January month end, just to see how well is it performing this year so far, just to see the most recent financials. We'll need a balance sheet for the business, which is, again, it's just all your assets, all your liabilities, and then it'll show your equity in the business. We'll need to see a rent roll, which is really just, it can be as simple or as easy as you want, but essentially to see all the rent that you have coming in for each unit. So if you have multiple units, just kind of list out the rent. So oftentimes I'll just get a Excel spreadsheet of, 1, 2, 3 Main Street, unit 1, unit 2, unit 3, unit 4, and they'll just list out all their rent payments. So if one unit's 500, they'll put 500 per month. And, I've got them in just handwritten people too, where they just write them on a piece of paper, hand them over. So nothing fancy there. It doesn't need to be on any formal sheet. Copies of leases could be helpful, because oftentimes that could substitute the rent roll, right? Because it'll show the rent on the lease. So that kind of helps, just so I can, when I'm doing my projections, say, hey, I know that you have your whole building filled out. Occupancy is at 100%, and I can verify it with the lease. Oftentimes we'll need 3 months bank statements as well, just to kind of see your, just to make sure that we are a good fit for you and we can handle everything, especially putting you in the right checking account or savings account. And a lot of those are the deposit accounts, to make sure that you're in the right account. Are you going to be doing, international wires, external wires, ACH manager? So just to make sure we get you in the right product on the deposit side, 3 months of bank statements can be helpful. If you're purchasing a property, we'll want to see a purchase agreement signed by both parties, and then hopefully we can close on time and make everything work out within the timeline. If you're doing, and this slide here, I should back up, is for businesses. The next one's for the personal items. So these are, if you have an LLC, this is what I would need. So I'll need your entity documentation. So this would be your Minnesota Secretary of State articles of incorporation or any other state you're in. If it's not a Minnesota entity, we'll need your operating agreement, your assumed name, bylaws, corporate minute meetings. Really what we're looking for is who's authorized on the account to take out loans on behalf of the business, and oftentimes, I use the example of if you're a shareholder, doesn't necessarily mean you have corporate authorization. For example, I own a share in Coca-Cola. Can I go and take out a loan in Coca-Cola's name? No, it doesn't work that way. So that's the example I always give. So we just need to say, hey, John Doe is the president of XYZ company. He can take out loans on behalf of the company and open up checking and savings accounts. We'll also need your federal employer identification number, which is basically your business's social security number. And then the last slide I have is we'll need 3 years personal tax returns, including your Schedule K-1s. Oftentimes, if you have multiple businesses and depending on how they're taxed, the K-1s can or they may not be included. So we always ask to include the K-1s, and sometimes your accountant or account person that does your taxes won't include them. So sometimes we just ask that they include them. Personal financial statement, it's basically a balance sheet for you as an individual. Again, all your assets, all your liabilities, and it'll show your net worth. We'll need your social security number and then a color copy of your official government ID. And if you are partnering outside of an individual, or if you have 2 individuals and you're creating a partnership, we'll need those for all of your partners as well. And same thing with the other slide. If you have an LLC with multiple owners, we'll need these items for that owner as well. That's all I have.
Okay. I do see a question. What maybe isn't clear here, a person can get a commercial loan on a single family house that they're flipping, correct?
Correct.
Yes. So, but you at Pioneer Bank, you have a mortgage department and do regular residential loans too?
Correct. We do.
It's just not you.
It just would not be me as an individual. It would be Jennifer on my team who she would handle all the residential mortgages. Correct.
Basically at Pioneer Bank, you handle all sides.
Correct. Yep.
And Jeffrey wants to know if you look for audited or reviewed statements once a company reaches a certain revenue threshold.
Yeah, so we would prefer to have audited. I mean, who wouldn't want to have audited statements? But again, it really depends on what is available. If it's a smaller entity, we're not going to require you to go have an accounting firm go out there, audit your financials. Like, it just doesn't make sense. So sometimes we'll take your internal numbers and we'll take them for face value for what they are. And then, assuming they make sense and can verify with the tax returns from previous years that your projections aren't just astronomical, or if they are, why are they? Some people that just happen to be in the right place that manufactured face masks, here locally, perfect timing when COVID hit, right? So their numbers just went skyrocketing, and that was why.
Okay, and Alex wants to know, can you give a residential loan on an LLC?
You cannot give a residential loan to an LLC.
Right.
It would have to be through a commercial loan.
And I have a question because I remember all the commercial loans I did. Behind all that, I had to personally guarantee a bunch of them.
Correct.
Is that normal?
Yeah, so that's fairly normal. Really, especially at our size at a community bank, almost all of our loans have personal guarantees attached to them. Right. The only exceptions that we have here would be if we're pushing up against lending limit, which means we're basically at our legal limit where we can't take any more debt due to the size of our bank until our bank grows bigger, essentially. That's where we could have things, and oftentimes we're talking, millions of dollars in the bank, $1 million loans where we may not require a personal guarantee from someone because they've been a customer of the bank for 20 or 30 years. They pay every single month. It's on auto pay. they have $5 million in the bank, and it's just a lending limit issue at that point. So just so we can do that loan. Otherwise, we'd have to tell them, hey, sorry, we'd love to, but you got to go to somewhere else. And rather than kick out one of our better customers, we'll not require a personal guarantee.
Okay, that's interesting, because I'll just say, when I got divorced, all those commercial loans and those personal guarantees got messy. Let's just say it's just part of it, because the way, even though the properties were structured in different LLCs with different owners, so as I would tell can you stop your screen share now?
I sure can.
And then I'm going to give you some more information here. It can get messy, and you just, we always need help to unwind things. And so what I always say is, be careful when you have partners, because just know who you're partnering with, really, and you have to trust them. You have to. And it's like being married. That's what I say.
Yes.
When you have partners, you better have it all drawn up ahead of time. So we're at the top of the hour, and I do want to tell you guys how to contact Brandon if somebody wants to find him. So let me put that slide up. Let me find it. Okay, I know where it is here. Here we go. Here is how you can find him. Do you see that slide? At the bank?
I just see your desktop, Leanne.
Oh, that's not working. Okay. That doesn't help you find him. Let me try it again here. I picked the wrong one. There we go. Here we go. There you go. That's how you can contact him. And I think Eric will put it in the chat box for you. And one more thing I want to say, and here's the thing, don't go away. We got quite a few people here. We're going to open this up to networking, because there's some more questions, and I'm going to actually let you folks come on, and we're going to be a group like a regular Zoom meeting. So this is going to be kind of exciting. Just so you know, I'm going to turn the record button off though. So first off, there's that. And then I just want to tell you, for myself, if anybody wants to chat real estate, you can do a free strategy session with me. You can go to my website, leanneriley.com. There's a whole bunch of buttons you can push to schedule. But talk about buy, sell, invest, or anything real estate. So now what I'm going to do is we have to do one. Oh, okay. That 612 number is my personal cell, Brandon says. So call or text anytime. Hey, you guys, he gave us an open channel. Right. That's pretty cool.
I won't promise I'll return your calls or chats anytime, but I will get back to you.